Peter Rose, Longwood Currency Trading. It's late October of 2021. It is a brutally damp, cold, rainy day, as we've had for the last couple of days with the storms coming in from the northeast. And sitting here looking at my current trade that I'm in, and I'm still underwater on it, but it's come way back and bumping into a little resistance area that it needs to penetrate before I think I'll be in good shape. And the result of me sitting here wondering about this is because of trade entry. This video is about getting your trade entry right. Get that taken care of. You know, what's the point of currency trading, right? It's to successfully complete the trade, close it out, make money. And we're not talking about a good trade versus a bad trade. A bad trade, you do something stupid, you could lose, and it's still a good trade. Doesn't make it a bad trade because it loses. I'm not talking about that. We're talking about a successful trade that you close out and make money. That's the goal of the whole thing. Just like in chess, as I've said many times, the goal is to checkmate the king, not whether you're going to play King's Indian defense or the Pez or whatever it is you're going to do. You got to get that trade entry right. That's the key to the thing. A lot of people would say that, oh, no, you know, it's managing that trade and squeezing it for all it's worth. No, you have no control over how much it's going to be worth. You have no control over how much money you're going to make, or if you're going to make any money. The only thing you have control over is how much you're going to lose on your entry. If you can do a successful entry and the trade goes into profit, your task is to bring that stop up and put it at break even. You could say, well, you know, I got to give it a little room to breathe because it's got to flop around a little bit and then it'll continue on in my direction. No. Because then you're playing jump ball trading. You're playing in a chaotic environment. You're taking whatever your win-loss ratio is and you're making it 50-50. And you're not going to win. You can't make those, you can't have those thoughts in your head that, well, it's going to come back, retrace a little bit, and then it'll go on ahead because that's the way things work. If you're trading up on a daily time frame or maybe even a 4-hour, yeah, you can say that. You've got an ATR on a 1-hour chart. Let's say it's 15 pips, and so you're not going to hold that trade for 15 minutes. I mean, you could. The ATR 15, the thing may take off and run 30 or 40 pips, and you go, hey, that's pretty good, and you get out. That doesn't happen very often, right? So if you're trading on a 1-hour chart and you get a 15 pip ATR, you're going to hold that for the day. You may hold that for 4 or 5 hours. Because in 4 or 5 hours, if the thing goes up, well, you know, in 2 hours it'll go up 30 pips. You know how it goes, okay? In 4 hours you'll have 60 pips. That's a good day. So, you can't get into a 1-hour time frame trade and not accept the fact that you could have a 15 or 20 pip retracement before the thing flips around and continues on. You know, and there's those that say, well, you know, if I'm doing this trade and it turns around, I'm not going to stay in there and see how far down it goes. Well, then your whole entry theory, your risk analysis is invalid. You're still jump ball trader. You ain't going to win if you're jump ball trader. You can't make this shit up as you go. And when you do, it goes against you quite a bit, and then you say, it's going to turn around, and I'll pull my stop off. I mean, I'm telling you, that's what you're going to do. I still do that. The safest thing that I can do when I go into a trade is to close the trading platform down if it's going to be a carry trade. Just close the trading platform down and go get a cup of coffee, because I don't want to watch the damn thing. It's either going to work or it's not going to work. And I feel that in the times where I have done long-term carry trades, it's gone 3, 4, 5 are against me, and then turns around and I get my money. So was I wrong about the trade? No, I was wrong about the timing. And that's, that's an important factor. The fact that it ultimately works out for you is no compensation for when it doesn't work out for you and you drop a 50 pip loss when you were hunting for a 15 or 20 pip gain, or a 60 pip loss, because that wipes out a lot of those other trades. You have to get your entry correct. You have no control over whether the thing is going to go up and it's going to work or not. Maybe you're new to trading, and so you're saying, well, what's the secret? How do I judge it for a long-term thing? What am I going to do? Teach you that on a YouTube video? Come on, I can't do that. This is a complicated process, and it's something that requires study, not an answer. There's no answer to this shit. You have to study the mechanics of price action to determine when your price action is in a probabilistic state for continuing in a particular direction. That's the best I can tell you. And then, because of that, you have a probabilistic opportunity that the trade will go in your favor. And if it goes in your favor at all, and then you bring your stop up to break even. I mean, look, what's the difference between having the thing go a little bit? Let's use my example. I'm trading on a 5-minute chart with a 5-period ATR. I set an 8 pip stop. Okay, it's not a close stop. It's an ATR and a half. I'm not going to set a 150 pip stop on a 100 pip ATR daily chart. I'm just not going to do that. The things change. But if you're trading up on the daily chart, you're not going to understand how to do this down on the lower term charts. You won't. It's not mappable. So I just take my example: 5-minute chart, 5-period ATR, 8 pip stop. I go into the trade, and it goes a little bit in my favor. It goes 5 pips in my favor. Great. That's when I move the stop. That's when I got to move that stop. I got to move that up to break even. Well, you're going to say, well, you get a 5-period ATR. It could come down 5 pips and it could stop you out. Yep. How much did I lose? I didn't lose nothing, because I broke even. You can say, well, it's going to turn around. It's going to continue to go up. Great. If you've judged the situation that is a good entry point and it does start to go up, you'll lose 5 or 8 pips until you confirm that and you can make another entry. Because if you're right, the thing will go up. But if that thing was to continue down past your break-even point and hit your 8 pip stop, now you've lost 8 pips. What if you don't get out? What if your stop is 20 pips? What are you going to do? Wait till he gets to 10 pips? 12 against you? 15? You're going to wait to get to 20 pips? I don't think you can. From a mathematical standpoint, I don't think you can. And I've done the math on this. I've worked through the win-to-loss ratio analysis for a whole matrix of changing wins to losses, stop amounts, and average win rates. And I'm just going to tell you, it ain't going to work. It doesn't work. And so when I go into a long-term trade, it makes my bowels just lock up, because I'm in an uncertain environment, because I have to let that price breathe, so that I'm going to hold it for 2 or 3 days. What, I'm not going to experience a 15 pip withdrawal or 20 pip withdrawal within that day period of time, or 4 or 5 day period of time? Well, when's the 15 or 20 pip retracement going to come? Is it going to come right away, or is it going to come after it's gone up 20 or 30 or 40 pips? I mean, come on. You don't have any way of knowing how far that trade is going to go up. I mean, that's the whole philosophy that the speculator bases their trading on. They're just looking for a couple of pips at a crack. I look at the momentum, it's going good, it goes 2 pips, 3 pips, boom, and I'm out. I'll take it, because that thing could retract 10 pips. And by doing that, if you know what you're doing, because speculating is a little bit more complex than day trading, but if you know what you're doing, you pick 2 pips up and 3 pips up and 5 pips up and 2 pips up and 3 pips up, and your win-to-loss ratio becomes 75, 80%. I mean, you look at the guys that teach this stuff on YouTube, where they talk about giving the price room to breathe, 20 pip stops, and all this other kind of stuff. When they're working with a small account, they're in there banging away, grabbing 3 pips, 4 pips, 5 pips, and making dozens of trades every few days, if not a day, because they know that the odds are in their favor. If you listen to the videos that the guys from Tasty Trade, who developed the Thinkorswim platform, these guys are expert traders. They say trade small, trade a lot. In other words, take a small amount of your capital and trade it a lot of times, and so over the long term you statistically make a lot of money. And when you lose, you don't lose a lot, because you're not trading with a large portion of your thing. I mean, that's a whole different philosophy of trade entry that as day traders we don't really concern ourselves with. You still have to concern yourself with it as a long-term position trader, but things become a little bit more flexible. But if you want to learn how to trade, you've got to do it on a day trading basis. You're not going to learn how to trade on a long-term basis, because you're not going to lose enough times to learn what not to do. Let's say you get going and you're trading on this long-term basis and you win 6, 8 times in a row. That could be your statistical winning likelihood. And if you continue that and you were to lose 6 or 8 times in a row against that long stop they're telling you to put in there, you're cooked. You're gone. Look, I followed all those rules. When I funded my my large account, I was trading minis for a few years, and I lost those mini accounts. And so when I did all this research and I did all this study, and I did it against a $40,000 bank in my simulated account. So when I went live with a $40,000 account. And I traded the way all these folks say that you need to trade, with long stops and blah, 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 blah. I mean, I hit the 6 losers in a row within the first couple of weeks of trading. And that cost me $12,000 of the 40, right there, $15,000 of the 40. Boom, gone. Now, I made my own errors after that, but I continued to use what you would call best practices for trading on a carry trade basis, long-term basis. I just got my ass chewed up because my entry wasn't good. It was okay to make it go into profit, but it wasn't okay to sustain, and it would turn around and take me out. And they thought, well, geez, it almost made it last time. I was like, I'll go back in. Well, if it was a shitty entry, even a shitty entry can can go into profit for you several times as it retraces and goes out of profit many times. You know, you just get chewed up. So I'd rather lose 8 pips with a profit target of 20 and make 8 pips on the trade and call it a day. I risk 8 and I make 8. I'm jump ball. I'm doing fine. If my win-to-loss ratio is even just 60-40, 60 win, 40 loss, I'm going to be fine. I'm going to be fine with that. 6 times I win 8, and 4 times I lose 8. So you're a 60-40 trader. You're just kind of like a break even. But you got to get to that 60-40, which comes back to you got to get the entry right. The only way you're going to get the entry right is to lose a lot of times to figure out what not to do. That's Jesse Livermore's things. The only way to get an education in the market is invest your cash, track your results, and learn from your mistakes. Learn from your mistakes. If you don't have a lot of mistakes, what are you going to learn? You're not going to learn shit. So, you want to learn at 20 pip stop level? You want to lose 20 pips? Well, you don't know what you're doing when you get started, or when you're, even if you've got 2 or 3 years experience. Look, I've got a lot of experience in this stuff, and I still do stupid shit. I can't even imagine if you're out there without good education, or listening to these fools on that are talking heads about how to trade currencies. I can't imagine that you're much more than a 25% winner. So you work out the math. You know, 7 times you lose, and 3 times you're 30% win, and 3 times you win. I mean, look at the amount you have to win in order to make up for those losses. You can't do it. You don't have the skill. When I work with somebody, we don't even worry about all that shit. It's a really simple methodology to work somebody through. Now, I had to learn that the hard way because I didn't have it done. I wasn't taught correctly. The education out there is crazy. It's more entertainment than it is education. When I got into real estate, I did 40 years of real estate, retired a millionaire as a result of that. Now, that's not to brag or anything, but if you do things right, you make money, okay? So when I started in real estate, there were people I could go to and talk to. Well, what do you do here? What do you do here? And the advice was good advice. It worked. If you went and asked somebody who was a real estate investor, gee, what do I do in this particular situation? And they go, well, you do X, Y, and Z. It isn't going to change from person to person because that's the way that you do it. Jesus, you go in and ask somebody, well, I'm having problems doing this, that, and the other thing in currency trading, you're going to get 15 different pieces of advice on it. You have to get your entry right. And if you don't get your entry right, you're just not going to be successful. And so the question becomes, how do you get that entry right? Well, you don't until you learn what not to do. So while you're losing, wouldn't it make sense that instead of using his stupid long stop levels, 20 pips or 30 pips, look, you lose 20 pips on a $1,000 account. Jesus, man, that's 2%. That's the most you're supposed to risk on a trade, but 2%. I mean, how much? Let's say you lose 2%. You know, 6 times out of 100, 60 times out of 100. What are you going to win in order to make that up? You don't have the skill for that. And even if you have a couple of years of trading experience, you might not understand the root fundamentals of how this stuff is supposed to go together. You may have just learned it on a kind of an instinctual basis, and that's great. But that instinct is not going to work for you. That instinct has to be based on fact, not on whether you got hairs standing up on your back or your gut feel. Well, where do you get that information? Where do you get that? Well, if you're going to do it on your own, You got to lose a lot so you learn what not to do. If you train with somebody like me, I'm going to tell you to do the same thing. I'm going to teach you certain things that will cause you to lose. You're in a simulated account. What difference does it make? And then even when you get into the live account, you may have to repeat some of that stuff, because I'm telling you the difference between trading a live account and a simulated account is night and day. It really is. So I want to get somebody out of the simulated account and into the live account as quickly as I can, knowing that you're probably going to lose 10, 15 times and win 2 or 3 times during that period. But based on the information that you get from trading all of that time and the preliminary work that we do, you're able to minimize your losses and then figure out what you're supposed to do so that you still have enough money in your account that you can place a trade with confidence, because you understand your entry level a little bit better. And then once you're successful at getting that the price to go in your direction, let's say it's long, and you bring the stop up, and for quite a while the price is going to retrace against you because you didn't quite get that entry right, and you'll get stopped out, but you won't lose anything until you refine that entry process, until you get those rules down right. So first you're going to lose just by, you don't know what you're doing. You don't know how to structure the entry analysis. So you're going to hit that stop. You can go do anything you want to do. Make it a 20 pip stop. Make it a 100 pip stop. I don't give a shit, but you're going to lose it. You're just going to go all the way. And if you set a stop and you change that and get out ahead of time, you're fucking kidding yourself. And anybody that tells you to do that is not, they don't know what they're doing. Anybody that talks to you about risk to reward, which is incorrect, it's really reward to risk is the proper way to state it, because that's the way the numbers come out when everybody talks about it, is they don't know what they're doing. I'm just telling you, as a physicist, bachelor's degree, come on, and a mathematician, I'm just telling you, reward to risk ratio stuff, anybody that talks to you about that, they don't know what the fuck they're doing. If you teach that stuff and you think you know what you're doing, throw me an email. You need some help. So you're going to set that stop, and it's a short stop, and you're going to lose a lot. So then you're going to start to learn what not to do. And so now you're going to catch that price, and it's going to go up a little bit. It's going to go in your favor. Now the next rule is bring the stop to break even. And now you're going to go to break even a lot, because you haven't figured out the probabilistic environment that price is going to, has the juju to go toward your profit target. Now, how do you differentiate whether you're in a trend or a chop environment? Because you're going to trade those a little bit differently. How do you learn that? You can learn it from a book, you're not going to learn it from a video, and you're not going to learn it by listening to me talk on this video. I'm just telling you the stages that you need to go through, even if you have 2 or 3 years of trading. You need to back up, and you need to make sure that you understand your fundamental foundationing principles of trading, because if you don't, at some point you're going to get caught up there, and you're going to be trading a $30 or $40 or $50,000 account or a $100,000 account, and you're going to fuck it up 4 or 5 times in a row, and you're going to go to the wood. And all that money that you made is gone. You lose $40,000 or $50,000, it's gone. You're going to be devastated, and you're not going to want to trade again. Where are you going to come up with another $40,000? You're not going to want to do it. And that's unfortunate, because you can do this, but you can't just get in and start trading and it all works out for you and you end up successfully trading for a couple of years, better than break even, or even if you're doing fairly well. If you do not have a firm grasp on those fundamentals, and I'm not talking about what a pip is or win-to-loss ratios or any of that mechanic stuff that they teach it. baby pips and all these guys charge you $2,000 to learn the stupid shit that doesn't mean anything. It's not worth $20 that charges you $2,000. You need to make sure you understand that foundationing structure of trading, not the market, but of trading. Then you can take your trading and if prices in the currencies aren't going well for you, you can trade commodities, or you could go in trade indexes or old tires or whatever the hell you want to trade, because trading is trading. I learned that a long time ago from guys that were trading computer microchips. That's what the guy told me. He started out as a shoe salesman. I said, how does a shoe salesman come to trade commodities in a computer chip environment? He goes, trading's trading. It's for sale. Doesn't make any difference. Once you know how to trade, you know how to trade. Doesn't matter. But you have to learn how to trade. The fact that you do some activity and it makes you money doesn't make you a trader. You have to get your entry right. Focus on that. What is the problem domain, as I've called it before, of the trade entry process? What we call trade analysis, the phase of the life cycle of a currency position. And that trade entry analysis. What's the problem? What's the problem you're trying to solve? Because if you can solve that, I think you're going to be really well positioned to feel much more confident and comfortable in trading on your position management and the exit methodology and all that other kind of stuff, that you're going to have a much better feeling for that. And when you have a better feeling for that, you've eliminated the fears and the anxiety of the entry process. Once you get through your entry process and the trade is moving in favor, now you're trying to make all these decisions. Well, what do I do with my stop, and how do I trail it, and when do I get out, and do I have the support and resistance lines, and it's non-farm payroll coming up tomorrow, and what do I do? If you feel that way, it's because you don't have confidence in your entry theory. If you have confidence in your entry theory, then you don't worry about that shit, because you go, geez, I'm uncomfortable in this trade right now for some reason, I'm out. I'll close it down. Even though it could be only 30% toward the profit target. Or maybe it's 60% of the profit target, and it looks like it's got plenty of juice, but you feel uncomfortable about it. You get out. You know why you can get out? Because you've got a good trade entry win-to-loss ratio, and you just get back in. And statistically, you're going to be fine. But if you don't understand the foundations of trading, you're not going to have that sense of confidence to be able to do that. You're going to hang on to those trades, trying to squeeze them for everything that they're worth. And that's a mistake. I'm here to tell you that that's a mistake, because you don't have any control over that. As soon as you start, do this for me, will you? Try this over the next couple of weeks, and then send me an email and tell me if it doesn't work. Take all of your trades that are in profit and moving toward the profit target. As soon as you see that start to slow down a little bit, or any kind of question in your head at all, close it out and see how you feel. And then feel good. You closed it out. You made a good amount of money. And then stay at the screen and watch what price does. How many times does price actually continue to go up a percentage that validates taking that risk from getting out where you did, as opposed to that price plummeting down on the pin bar? I'm looking at my current trade right now. Fucking price just dropped like a stone. 20 pips in let me look at the chart here. Go to a 1 minute. 20 pips in 1 minute. So, how often is that going to happen? And now you're going to be if you'd have stayed in that trade, you'll be all pissed off because price drop through it, and instead of getting, let's say you would have got 30 pips total on the trade, and now you only get 10 pips because you get a pin bar down or you got a spike down. You're going to kill yourself. Geez, I pissed off 20 pips. Well, get out up there. Well, what if it goes up 20 pips? Well, so what? You made 30. How much do you want to squeeze the thing for? Because at that point where you start feeling insecure about that trade, you're a jump ball trader. Would you make a new trade entry at that point? That's the question that I teach people to ask. Would you make a new trade at that entry? And if you wouldn't, close it out. And you'll feel much better about your trading. Do that for a few weeks and see what you think. Send me an email. Let me know. Let me know what your thoughts are. So, P. Rose, Longwood Currency Trading. Have a great day and have a great trading day.